Hello everyone, my name is Fran, FS Friends. Happy trading, happy watching. I know everybody come here try to make money. So today we're going to share one of the two way to make money. What's the two way of make money? That's to make money. One is use your time, your effort, your knowledge, your skill to make money. Just like you have a job, like you become a doctor, you become a mechanic, you become a waitress, waiter, and then that's the way. Use your time, effort to make money. The other thing is to use money to make money. What's the use money to make money? Like you go to a casino, you gamble, you use your money, you hope you can earn money, and also you can invest and you can speculating. All right, that's so today I'm not talking about the time and effort to make money. I'm talking about these two things, investing and speculating. Okay, so speculating and investing, let me do this way. So because I have to write in this way, so later on I show you. They both are use money, these things, they both use money to make money, okay? That's what they hope, right? Use money to make money. I'm not talking about the job, right? The job is like almost guarantee you can make money. But this one, you can use money, you should use money to make money. Also, you have a chance to lose money, okay? That's the other part. But first of all, let me talk about what is investment. Investment is simple. Investment is more like a predictable. Okay, predictable. Okay, it's predictable. Why is it predictable? Let's say we buy a house. No matter what price we buy in the house, we will say, oh, the price house will raise in 5 years. If not 5 years, 10 years. If not 10 years, 20 years, right? So that is a predictable, almost guaranteed. What's the reason the price of a housing will raise? Or you say, I buy a gold. It doesn't matter. Right now it's $1,600 per ounce. It will go up. If not 5 years, 10 years, 20 years. That's something behind that is a fundamental reason. The reason is simple. The housing price will go up is because the land are limits. The lands are limits, but population is relatively unlimited. So we have more people and more demand, the house will go up. And why the gold price will go up predictably will go up in long term is because of inflation. All right, the money get cheaper, and then of course the heavy metal will get more value. Well, maybe not value, at least the price. Okay, so we see investment is a more like relatively predictable and also longer term, right? It's longer term, long term. So what is speculating? Let's say we all know the house price will go up in 10 years or 20 years, but we do not know the house price will go up or go down tomorrow or next week or next month. It's same as a gold, right? We have no idea if it will go up and go down next month. So the different, this is the similar, this is different, it's unpredictable. Speculating is unpredictable, short term. In short term, we don't know what it goes, all right? So now, this is normally, everybody talk about this, okay? So I search the web, I find there's a huge missing point. This missing point, separate. That's the two things separate, investing or speculation. The two major points. I find nowhere, search the YouTube or internet, they don't say this. Or maybe I missed that. Okay, let's assume I missed that, but it doesn't matter. That means this is really important, okay, very important. All right, VIP, very important. Okay, why I say this point is really important to separate investing and speculation. What's that point? The point is leverage. Investing, if you don't leverage, you use one-on-one, is investing. And if you use 1 to 2 leverage, okay, like stock, if you use margin, you leverage. If you buy option, you leverage 1 to 20. And in the US, the currency is 1 to 50. Some other country, maybe up to 1 to 1,000. Okay, that's called leverage, okay. So let's see, why investing, why this leverage is separate the investing and speculation. Let me give you an example. We have a trader, okay, trader A, trader A and trader B. Okay? Trader A don't use leverage, they use 1 to 1, okay? The trader B, leverage, only 1 to 2, okay? We talk about just only 1 to 2. They all buy a stock, $100 a share. They all buy the same stock and $100 a share because, and then they also have the same amount of money, $5,000. Let's just assume this number, okay? So make it more clear an example. So this guy have 5,000 and then they don't use leverage. The stock is $100 a share, and trader A can buy how many shares? 50 shares, right? 50 shares, because 50 share times $100 is $5,000. They use up this money. But trader B, they use leverage. Okay, he used leverage, so he can buy 100 share because he can time 2 of this number. So he spent $10,000 to buy the same stock. Okay, so let me put the bad things first, okay? Bad things first. Okay, I'm going to show you the good things later. So what happened? The stock go down to $50 a share, okay? Go down to $50 a share. And trader A will lose $2,500. It will lose $2,500. It will lose or keep whatever. But trader B will lose $5,000. Okay, when you lose $5,000, your brokerage, your broker house, don't want to lose your money. They just loan you the money, right? You have $1. Okay, I loan you another $1. So now, what happened? In this one, they can keep the position, but here you will get a margin call. Margin call. You get a margin call. What margin call means? That means you either deposit additional money to make it above the margin, or they will close your position. What happened if right here you don't deposit additional capital there? They close your position, then you lose everything. The $5,000 is gone. But this guy, it still can go down and still can go down as long as someday we talk about long term. It go all the way up. His investment will get paid off. All right, but this guy, okay, we cannot say this is his investment capital. We probably call them a new term. Okay, I create a new term. Deposit capital. Deposit capital. Okay, DC, deposit capital. It's gone. 100% gone. So that is the difference. If you want to invest, you cannot use leverage. Everything can happen. Now, let me take a break, okay? And then I will be back to show you why buying a house is speculating, it's not investment. Stay tuned. Be right back. All right, I put this down in this way, and you can see it a little bit more clear. All right, so now I just say that as long as you use leverage, you are speculating, you're not investing. That's why I say buying a house, for most cases, is speculating. You're assuming you are invest to real estate. That's what you assume, but it's not true. Let's say the housing price in Bay Area, San Francisco Bay Area, the mid-range house price is about $1 million, right? So now you don't have the $1 million, or for whatever reason, even though you have $1 million, you do not want to put $1 million to buy one house. What you do? Normal people will put 20% down. All right, let's go this way. You put 20% down. Then you loan another 80% from the bank or whatever. So that is what they call, it's leverage. You are used 1 to 5 leverage already. Okay, don't think you are investing, you are speculating, but it's a relatively safe way to speculating. All right, so if we all believe this point, all right, leverage is speculating. Okay. You say, no, I don't think so. All right, let me give you an example. Okay, one house, $1 million house, you put $200,000 to buy a house, right? So you buy a house, you own the house, and then you own another. Okay, so let's say the house market price is $1 million here. I always tell you the bad things first, and then I tell you the bright side. Don't go away, okay? The bright side, I'm going to show you speculating a housing is a much, much better way to make money, okay? I will tell you later, but first of all, I give you the bad news first. Let's say this house price go down 20%. the house price go down to 20%, and then now it's 800,000. All right, so you still keep the house. All right, the different buying a house or finance a house, it should be say finance a house. Then trading is because they don't cut you off. They don't cut you off. You can still there. That's a condition. You don't own the house, okay? But conditionally, you own the house. How you own the house? As long as you make your payment, right? That's very simple. All right, you make the payment. You make the monthly payment, then you own the house. Okay, let's say it go down a lot of 40%. Now the house value is 600,000. You buy a house, 1 million. You lose money. All right, so most people, like in 2009, all right, in 2009 in Bay Area, the housing price chopped like 50%. So what happened to these people? Those people, even though the bank is not force you to close your house or take the house back, you will smart enough to know, okay, wow, if I pay off my house, I still own 400,000. It's not 400,000. That means I lose my 20,000, initial 20,000. I will lose a lot of additional 20,000. That's not the way a normal person will keep the house, right? A normal person will say, no, that's a stupid. I dump the house, all right? So I get some free housing, all right? Because if you don't return the house right away, you don't make your payment, the bank get to go through a lot of process. You probably can stay in the house for 5 months or maybe sometimes longer. If you respond them a little bit and negotiate a little bit, it takes longer. You have a free housing to live, okay? I'm not going to tell you this is a good way, but I just tell you the reality is like that. So then you say, okay, at the time everybody dumped the house, right? The smart people, those people recognize before the market go down to 40%, if it go down 30%, already people dump the house. All right, they either surrender or sell it or whatever, and now there's a lot of the supply to the market and drive the market going down lower and lower and lower. That is what happened. And most people they say, okay, if I rent the house right now because the house price are cheaper, the rental price will be cheaper, right? So they all do this, all right? So drive the price down. Now let me tell you one good things from here. One good thing compared to trading the market. The one good thing is this housing. All right, so now we all understand financing a house. Financing a house is speculation. Okay? I want you to make sure you understand your investment or your speculating position. If you don't know your position, you will have a huge trouble. I'm going to show you later. All right? So now you understand financing a house is normal people is 1 to 5 leverage. That means you are speculating. All right, no doubt about that. If you have a question, you argue about this point, please leave your comment down there. I will respond to you. Okay? I'm not financial expert, but this is just common sense. Common sense. So everybody have common sense. We'll figure out this is all right. So, but I say this speculation, financing a house, the speculation has a lot of advantage on that than invest or speculating in the stock or option or currency market. A lot of advantage. Let me show you what's the advantage. Okay, let's say same thing, $1 million house, it go down. Okay, the price 1 million and go down 40%. Okay, 1 million go down to 40%. I already show you a little bit, and then now it's 6. Now the house price becomes 600,000, 40%, 600,000. Okay, so you only put 200,000 down. Okay, we just don't talk about the financial things. Okay, the interest you pay and then the tax you pay. Okay, we just make it simple. Okay, even though you calculate those things in, you still have advantage. Okay, you gotta go down to here. If you're trading the stock market, they cut your account. But this one, as long as you make payment, it won't cut your account. So give you a chance. Okay, this is good part. Give you a chance. You can look to see if the price will go back up. If go back up, then you don't worry about that. You make money, right? If it continue to go down, you have an option. I just told you, you abandon to the bank. You have a one year free living over there. And if you find some other money, let's say it keep go down another 10%, go down 50%, which will not happen a lot, but it will technically will happen. It'll go down to 500,000. Now this time you say, okay, I don't want it. I just return it. You can do the good way to return the house without making additional payment, or you can do the ugly way, which means you stay there very long. Okay, I recommend you do the good way. All right, the house is 500,000. Now, let's say they put it on forced close, right? Forced close, you cannot finance, you gotta pay. Let's say you have another $500,000. You buy off this house. Nobody will check your credit, right? So if you need to finance that, you have to buy on the regular market. Then you put another 10% down. Now you put 100,000. Okay, your 100,000 plus 200,000 plus 200,000, and you get 300,000. Okay, 300,000, and you still own the bank 400,000. You still own the bank 400,000, and plus interest. Right? Interest is about 50% to 80% your principal, depend on the interest rate and the term, right? So let's say 70%. Right? If you pay off your house in 30 years, $1 million home, you get to pay 1.7 million to pay off your home. But if it's 500,000, you pay off the home. 70% is maybe 30,000. Okay, so you pay off your home 800,000. Is that the 1.7 million? You only pay. That's a lot of energy for that. So now you buy a house, your total cost, including the loss from here, is 400 plus 300, 700,000. You get the same house, way cheaper than your original impact. So that is the advantage of financing a house. Okay, now this is not enough. Today is a little bit longer, but stay tuned. Get back, I will show you what is, how, this is the housing, okay, you have advantage, but in trading, we are not talking about investing, but I'm going to show you this. But in trading, you don't have this advantage. Then you get to learn how to deal with that. I will be back. All right, I'm going back to this trading. Okay, so why people use leverage? Okay, very simple, really simple. Leverage can enlarge earning, of course. Can enlarge your losing as well. Okay, so let's say now I'm talking about the good side. Okay, trader A, same example, $5,000, $1,000, $100 per share, and trader A have 50 shares. Trader B, leverage. Okay, this guy is 122 leverage. All right, let me go to this way. I can write it better. Okay, 122 leverage. Okay, so he can get 100 shares. So when the price go up $50, okay, the price up $50, and this trader B make $25,000. They earn $25,000. He earn, because he get $5,000. He make 50% of the return on his deposit capital. Oh, this one can say investment, okay? Because one-on-one can say investment. Get 50% return. And same thing, this guy, $50, and he will make $5,000. As soon as it go up to this one, he make 100% on his deposit capital. Okay, we don't talk about investment. As long as you understand, you always change. You have to change your mindset to make sure you understand that everything, and you make sure the mindset will direct your action. Okay, if you have long mindset, you have a long action. Okay, that's why the whole thing's happy trading, happy watching is to change your mindset to make your better position to trade everything. All right, so now you get 100% return on your deposit capital instead of 50% on your investment. That's a huge benefit. That's why people use leverage. That's why we trade currency, because currency is 1 to 50. So if 1 to 50, what that mean? Okay, I don't even know. It's just 1 to 10. Okay, let's say 1 to 10. 1 to 10. Okay, this guy instead of 1 to 2, 1 to 10, and he's not going to buy 100 share. If 1 to 10, he will buy 500 share. Okay, 1 to 10. That means he get 50,000 and $100 a share. That's a 50,000 capital he used, right? And if he raise to $50, and then he get $2,500 return, $25,000 return, and this guy only get 2,500, and he get 25. That's way how many times? 5 times, 4 times, 5 times, 5 times return on his deposit capital. Okay, I emphasize this: deposit capital. Never think about that's your investment. Really important. Later we show you. All right. So now the problem is, if it goes down, okay, if you use 1 to 10 leverage, okay, even though it doesn't need to go down to $50, okay, if it go down, you get 500 share, okay, let's say leverage 1 to 10. As long as it go down $10, down $10, you lose $5,000. You lose $5,000. You lose $5,000. The broker house, you close your position by yourself, but you need to learn how to deal with these things. If you know how to deal with that, you have unlimited potential to make huge money, and you limit your risk. I think I already speak a lot, so I will leave this to the next video and show you the way to use this leverage without hurting your deposit, the entire deposit capital. Thank you very much. I have many new ideas for you. Please sub to my channel and thumbs up and click the notification bell. I see you next time.